if I look at the marks, though, I feel that it is a good representation. So the thing is with these things, you know, from an academic point of view, I think, yeah, it is debated, of course. And I think that we have to always refer back to a bell curve in terms of considering everyone, considering all circumstances. And I think that with your comment, I think that somebody that, you know, that is kind of has done it, you know, is smooth, is, you know, quick off the mark. And, you know, we have to give the benefit to a person. I mean, that can score high in a difficult time frame. And also considering that the quiz is really, the outcome is also testing time constraints compared to the discussions that are open-ended, and there it gives again the benefit to somebody that wants time, reflection, that kind of thing. So it is a difficult one, Janine, I won't lie. And I think at the end of the day we've got to just kind of, we've got to test everything. Yeah. And obviously if everyone bombed out, which is not the case, then I would have definitely considered, change the.
It's just about the last 4 questions. I know I had to rush because I spent too much time. Yeah, it's with these calculations. As I say, I'm a person that tend to do it twice just to make sure that my input is correct. So maybe I must just rely more on my gut of what I'm doing. Yeah.
Yeah, and you know what? And I think the thing is, you guys did really, really well, considering that in this time value of money quiz, I added extra. Those last few questions were more tricky than I had in the previous modules. So considering that they were difficult, considering I actually made the time harder this time, you guys performed really, really well. And I think that out of all the tests, this would have been the most difficult one. So
okay, cool.
So that's really what I can say. It is going to be the hardest quiz. And I mean, this week we've got an open application. Next week we've got an open application type of question, or a practical kind of question. And so there you can go all out.
Okay.
In terms of
but we've got a test again on Sunday, and then the open application assignment.
Yeah.
Okay.
And
great. Okay.
Cool. Guys, so just talk, pleasure, Janine. And just to comment on, hello, everybody. Sorry, I just kind of jumped in there. Okay, so the time value of money quiz I thought went well. I want to make a couple of points on the discussion posts, because I think that what's come from the marking is that there's also polar opposites. And I think you guys know the effort that went into the post, and that is, I mean, what you put in is what you get out in these kind of discussion type questions. It's not very often that you work your butt off and then in these kind of discussion type questions and something goes wrong. You know, that's not usually the case. Usually it's kind of correlated, and I can see that in a post quite clearly. So I just want to kind of broadly outline kind of how I saw the post. So definitely some people.
Is it only me? We can't hear now. Eh?
You off, Nicole?
Oh, Shingi?
Okay, we can hear you now.
We can hear you now.
Oh, am I back
please
again?
start afresh. Yes, you're back on.
Oh, all right. Okay, so 20% of the posting related to like financial theory in terms of understanding, what shareholder value is, and applying a little bit of the financial theory that we had learned in terms of, shareholder wealth is important, and how that it gets created, and that is one of the situations. If it was relevant, I'm saying, in your posting. So obviously, if you had a posting that was a stakeholder view, then you needed to explain why that is a stakeholder view and what's different between a stakeholder view and what's a shareholder view. And obviously, the one is creating shareholder value, the other one is not. And I think a couple of people misunderstood the three different elements in terms of, or let's just look at shareholder value and stakeholder value, because the stakeholder view is one that does not concern shareholders, i.e., spending money on employees because they're a stakeholder unnecessarily is that, i.e., that will not lead to shareholder wealth. That is a stakeholder kind of viewpoint. And I think it was crucial that you needed to explain in your scenario which one it fitted into in terms of a shareholder, stakeholder, or a shared one, because there's definitely key differences between shareholder, stakeholder, and shared value. Okay, so that was the one, and then it was linking your argument to the articles. In terms, you didn't have to re-explain the articles, definitely not in a 200, but just linking it back into those three core areas again. And then your relevance, your practicality of your example in terms of having an example. Some people left that out, and some people had really relevant ones that they clearly thought a lot about. And then there was about 20% in terms of your reporting format, grammar, and so forth. So I just want to comment what that means for finance. So somebody asked me to just discuss briefly, she felt that she ran out of words and therefore had to make a call to remove her references altogether and out. So I'd like to make a key point that finance writing is quite different to academic writing. Obviously, plagiarism exists. You may not just use somebody's stuff as your own. That's a definite, that's one and the same. But the thing is, in finance, it's definitely relevance. Now, references are relevant, but I would say that it's more relevant if you use it in your text. So you'll see a lot of the time when you're reading financial articles, the references are on a page at the back, okay? And it's not really the focus. The reference is kind of embedded in a sentence. So you'll say, quote, when you get that little bracket reference embedded in a sentence. So you'll use it as a way of talking. So Porter with your correct referencing when you're using it in a sentence mentioned that this or this is relevant. So that's basically how we use it in finance. Then also what's quite crucial in finance, and that's something that I also want to stress, is where it is your opinion or somebody else's opinion. So, for example, if I say to you, this organization did something that was really useful to employees, and that worked out. That kind of is more my opinion and my viewpoint, and whether it really worked out financially, yes or no, is very debatable. Versus if I had to explain to you, they implemented new KPIs and that resulted in a 10% growth in profit share in the next year. So clearly that then is no longer my opinion. That is then clearly becomes a fact. So you can, in finance, it's quite useful to use numbers, i.e. factual information, as in your argument, to give your argument or to remove that subjectivity and your kind of personal viewpoint from your argument. So that's something that I had to learn in my life a lot, because often what happens, you put your own kind of emotive language in finance as well to say, and the profits were significant in the next year. And then for somebody that you're talking to, what is significant? It might be significant to you, and that's clearly what's coming through in your argument. But is it 10%, 15%? And in finance, it's quite important to have the other person make up their own mind. So if I to say they implemented this KPIs and profit grew by 15% in the next year, the other person might say like, geez, I actually quite like 15% growth. Or somebody in a private equity scenario might say, you know what, 15% is just not good enough for me. So that is just a little bit of a different way of thinking in finance and how we speak about it. And also when you are then moving away from, a pure numbers-driven argument to something like taking care of stakeholders and employee role or something like that, or it really benefited the community as a whole, then again, I would urge you to find kind of things that substantiate your answer in terms of GDP growth or just somebody else. It even helps to say, there was even a news article written about this that verifies my argument and just gives it a bit more validity. So that is quite key in finance in terms of, whose argument is it, whose opinion is it? And unfortunately, a personal opinion is not nearly as strong as one that's been backed up by numbers or somebody else, yeah?
That's cool work. We are on...
Yes. Hello? Is there a question?
Continue, Nicole. I think they just didn't mute. Yes, we can hear you. Continue.
Oh, all right. Okay, so then that's then the last thing. Is there any other? And then my last thing that I want to say, and how does that then impact your assignment for the end of this week? Now, this week, you will, if you've read it, you will notice that perhaps the numbers seem quite easy, and they are. It's not difficult. It's not meant to throw you off. So if you can kind of just think about it a bit more in terms of what percentage you think the calculations would actually contribute, and what percentage the application of those numbers would contribute. So I would urge you to think about it. 50% is going to be calculation, and then 50% is going to be how you apply each one of those. So typically what's going to be important is, why have you decided the NPV over the other methods or IRR, or which one you've looked at? So that's not necessary to re-explain the methods, definitely not. So in the postings, whenever I say refer to articles, you don't have to re-explain what they've said. It's just using the theory and applying it to the calculations. So you need to clearly demonstrate why you've chosen the method and for what reason. And I would clearly ask you to look at the cash flows in detail, because they are round, they are easy, but they're there for a reason. Okay, any other questions? No. Okay, so then I'm going to, yeah.
Nicole, one question from me. Do we need to reference or not?
You do. So you do, but I would, it is ancillary. So for example, if you ran out of a word count, now in this post, you're not going to run out of word count. So references is important. Okay, so that is important. Every financial document has got references at the end of it, quotes or whatever the case. So that is important. But I'm saying, to your point, when you are writing it, okay, you're gonna have used, let's say a person used, let's use the articles report. You're going to reference the whole article and shabizhabel at the end, okay, so that somebody can find the whole article and refer to that if they want. But you need to embed the references in your text, so that, because I can promise you 99% of the people are not going to go read the article. So if you are saying, if you are writing to me and I've never read the article, then you're going to write to me and say, shared value means this. I'm going to say, well, that's coming then from you. Or you're going to say, rapport, whatever his name is, article, you know, that brief reference embedded in your text mentioned this, I'm going to say, okay, so then I'm going to think about the independence. I'm going to think about the fact that he's obviously studied it. There's, you know, it just gives it independence. So I'm just saying link your references to your text so that when somebody that doesn't know what you have in your mind can clearly see in your text what is referring to an independent source and what is coming from you. If that makes sense.
Okay, cool. Thank you.
Okay. So now we're going to just focus on this week's self-assessment. Now, some of this, sorry, just give me a minute. Everyone can see Excel here? Just not? Anybody can see Excel? Okay. So, some of this stuff is going to relate to, obviously it's going to relate to your assignment, but a lot of it is going to link back to your assignment next week. So next week is going to be integrated assignments. It's going to include time value of money. It's going to include NPV, and it's also going to include Excel skills. So to start off with, I'm just going to make a simple NPV calculation just so that we've got the timing of our cash flows right. Here I've got year 0, 1, 2, 3, 4, and 5. And I just want to briefly explain the elements, what goes into an NPV calculation. So usually on a project, you've got a minus or an investment that you've got to make into the project. Now, what are those elements? It's usually a machine or like a capital expenditure, but then there's also an element of working capital that you need to include. So the words and the verbiage will definitely explain to you how to calculate the working capital. There are many different measurements or proxies of working capital. It can be just a straight up, we need to buy inventory of 100,000, or it will be a percentage of my sales revenue, etc., etc. So just read up in terms of how the working capital is calculated. I just want to mention the working capital because usually it is an outflow in year 0 and it usually is then an inflow in year 5. And what is important about working capital investment is not the actual investment. Don't think about it as an investment. You need to think about it as a change in investment. So if I had to say to you that I've got 10 Rand of inventory on my books, 10 Rand inventory on my books, I am going to increase my inventory to 12 Rand. My cash flow is not the 12. My cash flow is going to be the difference between my working capital balances. Why do I say that? It's because for the project, what is relevant is the extra 2 that I have to go and spend and buy more. So think about what your actual cash flow is and not necessarily what the balance is. What's also going to become important in an NPV calculation is the concept of relevance and timing of cash flows. So some of the capital expenditure might have been incurred already. You guys need to make sure that the cash flows that you include in your NPV analysis is relevant for your project. How do you know? You know if the cash flow changes as a result of your decision. So if I had to say to you that I had a machine that I bought 5 years ago that I'm thinking of using in a new project, is that relevant? Not really, because I have the machine. Whether I accept or reject the project is not going to alter whether or not I've got the machine. I've got the machine. If I had to change the wording and say I can choose to use the machine in my project, or I can sell the machine, then suddenly I've got 2 options and I've got a decision, and the different outcomes of my decision is relevant for my NPV analysis. Okay, So how do we do an NPV calculation in Excel? Usually we're going to be given a rate. Next week we're going to look at the rate in more detail and how we derive the rates. But what I want to show to you is in the NPV in Excel, it takes the next year cash flow and discounts it to year one. So the first cash flow in year 0 should not be included. Okay, you need to add it at the end of the calculation. Okay, so just note that in Excel, it's just one little trick. So you can either do your NPV calculation like that, and that's quick, or you can calculate the present value of each and every cash flow. This hard method is useful to know when you need to start doing more complicated break-even analysis that we're going to see later in the self-assessment questions. Okay, so how do we do that? In the long method, obviously we've got 250, which is our initial. Sorry, it's actually more minus 250. And then I calculate the present value of each and every cash flow. And obviously my period is then 1, and my payment is 0 because it's not an annuity. And then my future value is the actual cash flow. And you can see I've calculated the present value of all of them. That then gives me, I sum the present value of my future cash flows. And what I've got to remember is to always just add back my initial, or add or deduct my initial investment, whether that's positive or negative. You must just make sure. So note that it's quite tricky to get the signage right, because here, remember, if I throw in a positive future value, it's going to kick out a negative present value. And that's important to just keep track of. Okay, so self-assessment 1 of this week has got a few cash flows and is at least a comparison of all.
Nicole,
yeah?
Sorry,
yes?
Sister. What's the logic of adding back the initial capital outflow?
Because it's a cash outflow. It just doesn't have any time value of money considerations, i.e. in present value already. It is donated. Sorry?
Yeah, continue.
It is as of today, because remember what we're doing with the, we are bringing all of the future cash that we've got to present day or today's value. That we can then actually add or subtract from our present day upfront capital investment. Oh. So the upfront capital investment is as at today. And that's why we don't do any calculations with it. Okay.
And Nicole, can you please go back to that example you were busy with?
Yeah.
And then, so on year 1,
let me just change it around, yeah.
Oh yes, I actually wanted to ask that. So do we keep those as positive so that we can get the correct?
So now, I know some of you are sitting here, why am I doing this? This is going to be crucial. The signage of your calculation is going to be crucial for next week in terms of your ability to navigate through Excel and getting these signages right, whether it's a cash inflow and whether it's a cash outflow, and your understanding of cash in and cash out. Okay, so that's why I'm going through this basic example, because as you can see, I've got positive cash flows in year 1 to 5, and that's why I've just got positive. I had to change it into a positive. What I also want to show to you is look what we've done here. What I'm summing, okay, in a very simple calculation, is what I'm actually going to be generating on my project. That's what I'm going to get back. Do you agree with that? Okay. That's the stuff I'm going to get back. Okay.
And then do you minus the 250 from that to give you the 175?
Exactly. And why do I do that? Now, with this simple example, you can clearly see the cash that I'm getting in, the 425, exceeds the present value of my cash inflows in the future, exceeds my original capital injection of 250. And how much does it exceed by? 175. That means as a shareholder, I am 175 richer That is the value add in this project. It's the amount that I've exceeded my original capital injection. And that's why we accept all projects with an NPV greater than 0. Because that means this has matched or exceeded my original capital injection, and not only matched my original capital injection, it has exceeded my required rate of return. In this case, I use 10%. So as a capital investor, I'm saying, okay, I have got my money back of 250 and I've got my 10% annual return and I've made 175. So I'm a happy investor. And that's why NPV is actually quite powerful. Okay.
So just one more thing. So if it so happens that on year 3, I'm required to do another capital investment of another 200.
Okay.
Do I then at the end minus 550 as opposed to 250? So do I add them together and minus the
So look what's happened. Yeah. So in year 3, I said suddenly I need to throw in some more capital, or my projected returns didn't work out, or maybe for that whatever reason I'm going to have, I've then got a negative. That changes the amount that I'm actually earning, because that's not going to be the sum of the present value of my returns. That then significantly reduces. And look, I've now got a negative NPV, which means that the future value of my cash flows that I'm getting on this project does not exceed my required rate of return of 10% and my initial capital injection. Okay. Yes. Any other questions? Let me just, for interest's sake, I know we're going over time, but the other questions are fairly simplistic when we go. Let me just change this slightly.
So Nicole, we'll have to do this in Excel. We can't use the financial calculator.
No, not going to be able to use this. Let me just change this around and say 20. Okay, no, sorry, 50. Okay, now see what's happened here. I've just changed it around, so I've got still some positive cash flows, but one big cash flow at the end. What can I now, looking at this NPV, and that's why I'm asking you to also apply yourself in the assignment of this week in terms of look at the actual cash flows. Would you actually take this on? Yes, I would in theory, and I'm going to explain that in theory, when I've got an NPV that is greater than 0, in this case I have, at 1.54 Rand, I'm going to accept this project because I've got a positive NPV. But what else can I say about this? Now I'm going to do my payback. When do I get my money back? Look at the cash flows. Is it actually only a year 5 that I get my payback? Or when do I get my payback? That is how that links to the NPV. And then lastly, what I'd like to say, is this actually a worthwhile investment? I'm getting R1.54 in profit. Yes, in financial theory, it makes sense, but I've gone through all this effort to make R1.54. Is this a worthwhile investment? Yes or no? Put it differently, in the real world, if you're sitting with a R1 billion investment for R1.54, are you going to accept it? Yes or no? That is basically how, so that's just the way to think. Maybe yes, maybe the 10% is great for investors, but that's just how to practically start applying yourself in this simple calculation. Okay, so that's why some of these calculations seem trivial, but it actually makes quite a lot of practical sense. So here we've got 2 mutually exclusive projects with their cash flows. And that is the question number 3 in your self-assessment 1. Which one will I accept? Now, based on the NPV calculation, I can do it either the long method, and I'm going to discount each cash flow, and you'll just roll it out for each cash flow. I've added the 15%. I've got my period linked to 1, and then my payment is 0, and my future value is the actual cash flow. And I'm going to do that for each one, and I'm going to sum my NPV. Notice that I didn't do anything with that year 0, and that's my NPV. Or the quick method, which is fine, but just remember that my NPV calculation only starts at the end of the year, of the first year, and I have to have a separate addition to my year 0 cash flow, whether that's positive or negative. So based on this one, obviously I would choose cash flow A. Let's just do payback. So payback is basically using the future cash flows unadjusted for time and seeing when I'll actually get my money back. So it's basically a little bit of a trial and error scenario for cash flow. I'm only going to do it for cash flow A. You guys can carry on with the Excel. I've got an initial investment of 350. I deduct my year 1 cash flow. What am I left? I deduct my year 2 cash flow. What am I left? And then year 3, I'm left with 175 that I still need to claw back in my year 4. So what does that do? 175 divided by the cash flow that I earn in year 4 gives me a pro rata time, and therefore I'm able to calculate that it takes 3.39 years to get my cash back on my original value capital. Now, which one do I then accept? Here you can say, well, on the payback method, I want the quickest payback method, and that is obviously cash flow B. Now, they've thrown a spanner in the works because obviously here we didn't adjust for time value of money. Now, some people are not concerned with time value of money. They just actually do just want their cash back, but that's not theoretically correct because we do know that there is a time that relates to, or there's a value in time. And then what do? In the discounted payback, we present value our future cash flows, and I've done that individually for each one. And then you just repeat the same trial and error. You deduct the present value of the future cash flows, and then you see how quickly you get your money back. And again, still based on this one, cash flow B is the good one to consider. Now, the profitability index is quite a useful index because in terms of my comment to, have we gone through all this effort to make 1 rand of capital, this profitability index is one that can tell us our effort ratio. It's really an effort ratio because here what do? Is we take, basically you can do it on the discounted method. You can, what you do is you calculate the sum of your future inflows. Okay, so that is the present value of your future inflows, and then you divided that by your initial capital, and then it gives you a profitability index. So if we go back to the simple example, we basically take the present value of our future cash flow, so that is the sum of all of those divided by our original capital, and we can see we've literally got a very small PI, and that is where that one becomes quite useful in applying yourself. Okay, this one. Okay, so somebody asked me about this one. This is a perpetuity calculation. That one, you basically, there's no formula for it. There's no Excel for it. The perpetuity calculation is equal to cash flow 1. So what you need to be clear on is it is cash flow 1. So if I give you a scenario of 0, 1, 2, for example, and I say that I am going to receive, I've received 100 Rand today, but I'm going to receive 100 Rand into the future, then I need to make sure what am I actually calculating in the perpetuity. So you'll have to do two calculations. You will calculate, you'll use this formula, which equals cash flow 1. My cash flow 1 is that number, not this number. Okay, so what is it going to do? You use your cash flow 1 and you divide it that by your required rate of return, which is the R minus the growth. The growth rate is basically how quickly that cash flow is going to grow, if at all. Sometimes it's 0, like in this case. Okay, so what am I going to do? The present value, the perpetuity calculation takes all your future cash flows and discounts it back to year 0. That's why it uses cash flow 1 to bring it back, and then you always have to remember to add that one back as well. So here I have got 97,000 Rand perpetuity, annuity that's going to go into perpetuity. My required rate of return is 11%, but that 97 is going to grow by 4%. So it is the 97 divided by 11% minus the 4%, and that gives me my present value of my future cash flows. But then I remember to deduct my initial capital, which is the 1.5 million, and then I get a net present value. So now you guys are starting to understand the difference between present value and net present value. Okay, so the second part to this is just a, let's just read it. The company is somewhat unsure about the assumption of the 4% growth rate in its cash flows. At what constant growth rate would the company just break even if it is still required to, if it's still required an 11% return on investment? So basically what I've done is that we know now that I'm going to break even when my net present value is 0. And that's why we say anything above 0 I accept because I'm in a profit situation, and anything below 0 we don't accept. So I'm breaking even when my net present value is 0. What is my net present value? It's the sum of my initial capital plus the present value of my future cash flows. And what do I need to solve for? I need to solve for my future growth rate, or what is kind of the growth rate that I can accept to break even. And if you solve for that, you guys can do this mathematically, then you get the answer. Okay. Any questions on perpetuities? No. Okay, that is then, all right. So I just want to go through now. This is in your more advanced NPV analysis. So this is typically something that you're going to start seeing now. So we have got, sorry, let me just move this a bit. Okay, you have been hired as a consultant for Pristine Inc., manufacturers of fine zithers. The market of zithers is growing quickly. The company bought some land 3 years ago for 1.4 million in anticipation of using it as a toxic waste dump site. Okay, so whenever I see something that has happened in the past, like accounting, I basically don't even think about it. The only other, because it is irrelevant, it is a sunk cost. Now, please just remember that in your cash flow, you need to justify the inclusion as well as the exclusion of items. So when I'm going to say something like this, in my cash flow, if it's excluded from my cash flow, then I'm going to say 1.4 million is excluded. It's irrelevant, or whatever you want to say, what you want to call it. But in financial theory, it is a sunk cost. Okay, and there's a mark allocation for the irrelevant items that is not included in your NPV analysis. Based on a recent appraisal, the company believes it could sell the land for 1.5 million. So now suddenly there is a relevant decision here to be made. because if I use it for my project, that means I don't get the 1.5. So that's why I'm going to include that 1.5 in my analysis, and I'm going to get a mark for saying that was an opportunity cost. Okay? And then in 4 years' time, the land could be sold for 1.6 million after tax. Now that is also something that's going to be different if I choose to accept the project or not. So that must definitely go into my analysis. And that's why I say at the end of my project then, even though I've lost the opportunity of selling it today, I then have the opportunity to sell it at 1.6 at the end of this project. Okay, the company also hired a marketing firm to analyze the zither market at a cost of 125. Is that relevant? No, it's a past cost. So that's, I'm going to say marketing 125, just type it out, irrelevant, it's sunk. Okay, and that's a mark as well. The zither industry will have a rapid expansion in the next 4 years with a brand name recognition that brings to bear. We feel that the company will be able to sell 3.8, 4.7, etc. units each year. So what I've done, I've literally written the number of units. I've got my price. They told me that it's $650 per unit. And because it's going to be a fad, we feel that at the end of the 4 year period, nothing is going to come. And that's why I've got zero cash flows thereafter. So obviously easy revenue calculation. But what I'm trying to say, even though this is a bit more of a simplistic calculation, please keep in mind what your cash flows, your sign of your cash flow. This is a cash inflow. Then it's told me that I've got fixed cost of $425 per year. And that's obviously a relevant cost. We all know from costing that fixed costs is fixed and are not really relevant, but it is relevant if our decision changes the fixed cost. So here, based on our decision whether to accept or reject the project, we are going to be incurring this fixed cost, and therefore it is relevant. Variable cost, we've got a percentage on sales, and that is then a negative cash outflow. Depreciation, they gave us some rate. This is an American question, so don't worry about it. Just use my Excel figures. The depreciation in the questions will be fairly straightforward. It'll be 4 year depreciation or 3 year depreciation. It'll be not on a reducing balance. It'll just be straightforward, because one day when you managers, you'll get the depreciation figures. And that gets us to the earnings before interest and tax. So what am I highlighting here? I'm highlighting that I have to first calculate the earnings before interest and tax. Why do I have to go through the whole accounting measurement for us to actually focus on cash flows here? Well, the answer is lying in your tax figure, because you need to, SARS taxes us also on the depreciation or wear and tear, whatever we granted as in the allowance. And that's why we have to calculate the cash tax. Okay. So here we needed to do all of this rigmarole to calculate the the tax, and that's what's relevant. So that is our step one, normally in NPV. So we've got our tax and we've got our revenue lines and other costs. So what then the step two is, we need to get our actual cash flows from there. So what did I do? I took my net income. Now there's two ways you can do this. I took my net income, but I reversed depreciation. Okay. Otherwise, you can start before the line on an earnings before interest and tax, but then remember you are sitting a bit of before tax position. So everybody happy why I had to remove depreciation? It is non-cash. So in year one, I've got my capital spending of 3.5.
Nicole?
Yeah?
Just a question.
No problem.
I'm just on the non-cash items. What happens if the actual cash inflow of the sales has not hit the bank account? Do we recognize when the transaction happens, or do we have to then separate if it's a receivable, and how do you deal with that?
So remember, most of this from year 1 to 4 are actual forecasts. So this is projected cash. What hits our bank statement is, or our bank is going to be a completely different argument. And next week, we're going to be dealing with sensitivity analysis. So this is the starting point for next week work, because how do we know this is 650? It could be 200. So that is how we're going to start thinking about it. Okay. So this is forecasted cash flow. Forecasted depreciation, forecasted everything. And what you're going to have to do in practice is somehow find information on how to forecast this. So where do you start? You use competitor information, you use economic data, you use actual company trends to forecast this. Marketing surveys, consultants that will tell you how to forecast, etc., etc. Forecasting is not actually that difficult. So when I became an analyst, when I saw the forecasts on like APSA or whatever, it's actually like you take your top line and look, it gets a little bit more complicated. It took me 3 years eventually to forecast the thing. But anyway, the point is you're actually dealing with a fairly simplistic NPV in the end of the day. So that's just something that's quite interesting. Net working capital. So here they told us that the net working capital injection has to be 125. So assume for your calculations that you always get that back as a positive cash inflow. So again, you're going to have to keep a track on your inflows and outflows. So here's my total cash flows. How do I calculate NPV? So I'm told that I need a required rate of 13%. So I type in NPV, my rate, my values. Now note that it shows me value 1, not value 0. And that's why I can't add value 0, which is my original capital, because Excel doesn't do that. Okay, so that's why if you stick to these numbers, you can't get it wrong. Value 3. So that's my sum. And then, of course, I've got to then separately add my time 0 cash flow. Or you can do it the long way. It's also fine if you present value each cash flow and you just link it to the actual period number. So you do that for each one. At the end, you sum it again, but note, I can just sum them all now straight. I don't have to have that initial capital back again. So that is my NPV of the project. Okay, so that was then, is there any questions on this number 1? Whoever's attempted it or... No. Okay, so just a bit of a extra. Sorry, just let me move you guys back again because I can't see. Okay, so here I do have a resale value of the machine. I think they gave it to in the blurb. They say at the end of the project, the equipment can be scrapped for 400. So just remember that that 400 flows back into my cash flow, but at what value? Okay, so I'm going to make proceeds of 400, but I need to remove tax. So it is my after-tax value that's going to flow back as a positive at the end of the period. So just remember that. Okay, no more questions on this one? Okay. Okay, this is going to be the last one. To solve the bid price problem presented in the text, we set the project NPV equal to 0 because that's basically the minimum that we can accept for the project, and found the required price using the definition of operating cash flow. Thus, the bid price represents a financial break-even level for the project. This type of analysis can be extended to many other types of problems. Dahlia Enterprises needs someone to supply it with 120,000 cartons of machine screws per year to support its manufacturing needs over the next 5 years. And you've decided to bid on the contract. It will cost you 870,000. That is definitely relevant. Why? Because it will cost me. It is a future relevant cost. And that's why I've included it as an outflow in my year 0 calculation. And you will depreciate this on over the life of the project. So my depreciation calculation is going to be simplistic for you guys. It's going to equal to the initial investment divided by the useful life of the project, or whatever they tell you the useful life is. You estimate that in 5 years' time, this equipment will be salvaged for 70,000, and that is definitely something that I would include in my calculation. So what did I do? I said 70,000 times by 0.65 because I took out tax. They said that our tax rate is 35%. So that is my after-tax salvage or proceeds that I'm getting. Your fixed cost will be 325, and that's exactly what I added as a negative cash flow. I needed to make 120 cartons. They told me the price is going to be $17 for it. That's my total revenue, is my cartons times by my revenue per item. That is that is my revenue, and then I minus my fixed cost. My fixed cost, they told me, is the R10.30 per, my variable cost is the $10.30 per carton. Just note that revenue minus variable cost is contribution, just for future references. Minus my fixed cost, minus depreciation, gives me my net income before tax, and then I can actually calculate my cash tax, and that is my net income after tax. Now again, I reverse my depreciation so that I am left with operating cash flow. Then obviously I've included my initial investment. I've got another working capital investment of minus 75, which I get back at the end of the period, along with my proceeds on sale of my machine. And then I calculate my NPV for the project, which is equal to I've made it the short method. Just notice that I've got my working capital in there and my initial investment in the actual machine. So what's a bit more trickier is assuming that the price per carton is 17. Find the quantity of cartons per year you need to supply to break even. Now, this is going to be important for next week because that's when we're going to be starting to look more closely at break-even analysis and sensitivity analysis. So where do I break even? I break even when my NPV is equal to 0. So what does that mean? It means that my future cash flows is equal to my original capital. So I needed to strip out my actual capital elements from my operating cash flow elements. So I needed to work back all the way to my number of cartons. So exactly how I constructed this argument to get to my NPV, I need to work back and solve for my 120. The only difference, I'm going to make NPV equal to 0. Okay, so where do I do that? I've worked out. The first step I'm going to do is I'm going to present value my future capital items that do not relate to my operating cash flow. Why? So that I can strip it out of my NPV. So I've done that with my future value items. So that equals to the 120. That's the sum of my proceeds on the sale of my equipment and my working capital that I'm getting back. And that is equal to a PV. Now, what might happen, look, what happened is I had a positive cash flow, but then suddenly remember, if I type in a positive future value, the Excel spits a negative out. That's not actually a negative number. It's just the way that the calculation works. So I need to remember to not minus it. Well, I need to minus it from there, but I'm not going to minus it. It's not a negative cash flow. It's just purely the mechanics of a PV calculation that it gave me the negative. So just watch the signs. So I took out the present value of that out of my net present value. Sorry, let me just find where I did that now. Okay, so that's the present value of my initial capital outlays, my working capital and my machine. That's already in present value terms, and that then gives me the value of these items that I have to remove from my net present value. Why do I do this again? Because I want to focus again only on where am I breaking even on my operating cash flows, or what's going to result in me breaking even on my operating cash flows. And that is essentially what I need to earn from my operating cash flow. So let me just repeat this differently. This figure you can see is clearly different to that NPV. Why is it different? Because I've got all these capital elements in there. I want to equal, in a break-even analysis, I want to equal this original capital investment. So that's why I'm going to strip it out, and I'm going to get a point what that I need to reach to earn to break even. So I've got a present value number of my future cash flows that I need to earn. So what does my future cash flows need to be? So if I know that my present value, in order to break even, my present value of my future cash flow has to be the 876. How do I convert that to an operating cash flow? I work out the payment of it, the actual annuity stream of it to break even. So they've told me I need to earn a rate of 12%. My number of periods is 5. My present value to break even needs to be 876, and my future value is 0. So my operating cash flows has to be 243. So these numbers has to be 243. What does that mean? The 243 then means I need to solve for, that is my break-even point, and now I can solve for my quantity. So now what I've done is I've said, okay, I need to reach an operating cash flow of 243. That equals the difference between my sales price, which is 17, and my variable cost of 10, times my quantity to break even, minus my after tax, so I'm going to tax that, minus my fixed costs, and then also I'm going to take out the after tax portion of my depreciation as well. Well, I'm going to add it back at least. Because remember, depreciation is in my accounting statement. I do not have it in this 243 cash flow. So that's why I've got to add back my depreciation. And if we do it like that, we solve for our quantities. So this is a bit tricky because I've put it all in one line. What you could do differently is you can do it step by step to say, okay, step 1, this has to be equal to 0. How do I get that? Let me then remove my present value of my capital items. Let me remove the present value of my future inflows. Then I know, what am I left with? I'm left with the present value of my operating cash flows only. And then you start removing each individual item until you've worked back to the number of cartons. I hope that clears out that one a little bit. Any questions around this one?
Sounds very complicated, Nicole.
I think it is complicated if you try and do it all in one bash, like I did. So if you do it step by step, for example, and you use your own way of calculating, then I think it will make sense.
Okay, Nicole, quick question. Sorry, on page 275, there's an example there for present value where they're dividing by the percentage to the power of 8 because it's 8 years. When do you use such calculations?
Sorry, so just repeat that again.
I'm saying on page 275, there's a calculation there of the textbook. There's a calculation there where they're trying to get the present value and they're dividing using the percentage to the power of 8. I'm saying, when do you use such calculations?
Okay, I can't now exactly think about it, but I think perhaps they use the formula method.
The formula. Okay.
Yes.
Which is the formula from chapter 6? Is it the formula from chapter 6?
Exactly. So what I've done here, and that's like, that's, for example, doing, sorry, I'm battling with this today. Yeah. That would be doing it. So you see here, I'm doing it with Excel for each. Sorry, now I've lost my train of thought. I can't remember. But yes, it's the formula method. So that's basically taking each one of these cash flows, discounting it by the n-1, all those formulas that you had previously seen.
Okay.
I'm sure that there must have been 8 years or 7 or 9 years in your example. But I'll have a look at that if it's different to my explanation to what I've given you now. But basically anything to the power of is usually the power of n, which represents your number of periods or the number of times you're compounding. But remember, if it's -1, that means you've got a normal calculation. If you're just using n, that means it's like payment in advance, all of that kind of things come into play into those determining whether it's n-1 or n or whatever you're dealing with. N divided by. Okay. Any other questions, guys?
No, just a request from my side, Nicole. Is it possible that you could send us your example like you did last week? Because it helps you spend 4 hours on an example and you can't quite get it right. Let me take a look at your solution and it makes things far simpler.
Okay, it's sent. I'm going to send it right away. Okay. Let me just see how I can. Any other questions, guys?
Yes, Nicole, I looked at the test results and went into it to see what's the right answer, wrong answer, but it doesn't give me the calculations how to get it. Is there maybe a memo that we can also just reference back to see what we did wrong?
I can send out a memo, yeah.
Please. So, yeah, so just for the ones we got wrong to see what we did wrong in the calculations.
Sure.
Thanks.
Can I do that by the end of the weekend?
Yes, sure.
All right. Okay. So I'll send out the Zoom. Any other things? Okay. So the last comment that I want to make is now you can start seeing how we are delving a little bit deeper into the application kind of it. So now how does this refer back to the assignment for this week? Clearly, guys, again, I can't stress out, look at their cash flows, see what they mean, and apply yourself in terms of the different methodologies and why you would choose a method over the other. Okay.
And Colin, a quick question. For example, you just did a very long calculation now, and I don't see a CEO or a director trying to solve a net present value amount to get to a decision. So I'm just struggling to find is there any other ways that people are using to get to such decisions? Because I mean they're still making decisions in terms of trying to find out which project to take care of, or they're getting the accountants to do the work and just looking at the numbers. So I'm just trying to find us in terms of us trying to crack our minds, trying to find all these calculations. I don't know if I'm making sense.
So I suppose in a nutshell, you're asking why are we doing this? Is that right?
Yeah, kind of.
Okay. So why are we doing this? And thank you for your question. I think it's a very good question because I think in terms of your first comments, you don't see CEOs doing this. They should. Because good CEOs that I've spoken to knows these numbers of their businesses and of their decisions. A good CEO would scrutinize all the information of the accountants, of the consultants who pick it, because that's where things go wrong. Because what invariably happens is that you get a large or a small organization, whatever happens, and this happens 99% of the time, is you get a McKinsey or whatever that does your NPV analysis, and you get a nice document that includes all your NPVs. Firstly, as a CEO, you need to understand how to calculate this NPV. You agree. So you need to understand exactly how they calculate it and what what inputs they are using, so that you can actually make your own decision. Because that's point number one. As a good CEO, they'll know the numbers. The second place where you'll see this very clearly is if you, like in the listed space, where you are sitting across from a CEO, and basically what I've shown you now is a fairly summarized, but it's not very far off to an actual financial model, how shares are actually valued by analysts. So now I'm sitting across the table from a listed CEO, whoever it is, and I'm saying to him, we are talking about revenue growth forecasts. We're talking about expense growth forecasts. We're talking about timing of those. I'm saying, for example, if I'm speaking to whichever company, I'm going to say to the CEO, okay, so when do you think your strategy is actually going to start materializing? Why is that important? Because I'm going to adjust my model for that. So I think what is quite interesting in this course is how much this financial theory is actually used, and how it is actually the thing that we are doing as analysts, and how the investment community functions, and that is how an organization should function internally. I don't think they do, because ultimately that's where you get the disparity between why an analyst values a share price differently to what a manager sees the share price being. So what should happen in theory is analysts value a business based on exactly how I've shown you now. Yes, it's simplistic. I've got my growth rates, and a lot of work goes into what the growth rate is. Because if I can say to you that Absa Bank's earnings is going to grow by 15%, what's the difference between 15 and 14, 13.5%? A lot of work goes into that rate, okay? But the point is, it's actually just one rate that I'm applying to a simple model. So when I'm sitting across from any CEO, I'm debating that rate because it's actually going to go into my model. So things in investment world works on financial models, and this is exactly what it is. So it is very, very, very practical, and I will show you. I'm the guest speaker at this week, and I'll show you how actually the same it is in the real world. The difference is that we are debating intricacies of these calculations. So that's why it seems tedious. It seems not important. But when I'm sitting across the table from people, particularly, let's say you're thinking of dealing a project, you're trying to buy a mine, for example. What's going to happen? You're buying from someone. They're going to do their NPV calculations. You're going to do your NPV calculations. You've got a purchase price. They've got a selling price. So obviously their inputs into their valuations is very different. Now, how do you actually come to a price that's somewhere probably in the middle? You both have your financial models. You should have your financial models. And the best CEOs I have that I've met is in line with investment analysts, and that they've got that investment mind. Because unfortunately, many CEOs are operational nature. They know their businesses in terms of operating it, but then in valuing their business, that's sometimes a disparity. And that's sometimes a big reason for share underperformance, because there's a communication gap in between what CEOs communicate and what analysts input into their valuations. Valuation models is exactly what I've shown you here today. I hope that answers your question.
Thanks, Nicole.
And I went through my whole CA career, 7 years of study, saying, why do I need to do this? And then I got on the job on the first my first day, and they're like, well, quickly make one of these. Please, can you value the JSE? It looked exactly like this. And that is the fundamental basis of any valuation, whether it's an investment internally or external investment, where you're going to buy, everything revolves around NPV, and IRR calculations.
I got
Nicole,
yeah.
Just another practical one whilst we're on it. I have difficulty in the brands arena because it's so intangible, especially in terms of marketing. I think in the B2C arena, you can always relate back to sales, so many cartons, so many whatevers. But at the moment, I'm in the engineering space, B2B space. Tenders are awarded, and often it's based on, well, a lot of variables like BE scores and. So then I get confronted with the fact that a brand doesn't help us with the tender. So and also to really accurately calculate that brand awareness, brand equity, it gets quite tough. So while studying this, I've been trying to kind of figure out how can I use this to sell the things that I really want to do, because I feel our company really needs to invest in developing their brand. But I really need to give them the numbers. So have you ever dealt with a scenario like that? I know, because it's so intangible, it's so difficult. And is there any advice you can give?
So the way, I mean, because like everything in investment terms is uncertain, because everything is forecasts, right? Every single thing, it's a future forecast, whether it's a brand, whether it's an intangible asset, what you're trying to, forecast, whatever the case may be. So I'm trying to understand your exactly what you're doing, wanting to do, but basically what you can do, and that's what we're going to be doing next week, is to value it, whichever valuation model you choose, and then apply sensitivity analysis to it. So you have a best case scenario and a worst case scenario, and that's always a good way to present an argument. When you're saying to somebody, and again, it leads back to our original debate, or my original point in the discussions, is like it's not every single person will have a different number to plug into their model. All right. So let me not be the decider of the number. The person you're talking to decides the number. So you give them the worst case and the best case scenario, and they can decide exactly what they want to plug into the model. You've provided the infrastructure for it, and they can plug and play as they wish and see the best case, worst case, or most likely scenario. And that's the place in finance that's really helped me a lot in terms of, because there's no concrete answer. So I'm not trying to enforce my view on you. I'm trying to work as a team to try and get to the right answer. And I'm just putting certain things forward. Now, what is it exactly that you need to value? Actual intangible assets.
Yes. So I would obviously.
No, I'm just saying. I'm just joking. I'm saying zero. It's not true. It's not true. So sorry. What are the brands that you? What is it that you're valuing?
So when I did my honors, we also did like brand asset value calculations and things like that. But again, it gets so complex because these guys, I'm a one-man band. So there's no like market support or anything. So for me to then get the data to actually calculate the brand value or to kind of get to an estimate of the brand equity, that's kind of, I think, where I really struggle. And then to kind of, it just annoys me because you see everything else getting money and investments because they can give a number. And because I'm unable to, I kind of have to say, guys, I think it's a really cool idea. I think you should do it. But that doesn't cut it.
Maybe just in simple terms, a good example would be, guys, do we spend 500K on going to this expo? How do you link that expense based on expected return in sales? Because, you can have the greatest stand at an expo, but how do you actually get to a concrete sales number based on that? So in what time frame? So maybe that's
so you're basically encouraging people to put up the banner at the expo, and that will, in theory, link to an increase in sales. And how do you measure the number of sales?
So I wish it was that easy because we're not. So we're really going to the expo for awareness. And it's so difficult to measure that awareness because we know that no one that visits our stand will actually buy like a 150 million rand engineering project just because they saw us at an expo. So it's not like we're going to be selling cupcakes at a show, or, it's such a big thing that we're selling that it has to go through a tender process. It has to go through a complex bidding process, even if it's not a government tender, even if it's for the staff SAB. So it's very difficult to say what the rand value would be that results from an expo. But the fact is that if we're never at these expos and we suddenly appear at a tender, why should we actually take you guys? Because we work for the same company, we do our MBA together, we CrossFit together, we do it together. But so when Core applied for the job, we had to move from PE. He was actually like, I don't know if I want to leave SAB and join these guys at this company, because again, it's a brand thing. Do I trust that I'll have job security based on the website? The website looks shocking. Do I actually want to be part of this company? So I do feel that we are emotional beings, and we do make decisions based on our instincts. And we do see a brand and we kind of think, oh no, that's a bit dodge. It doesn't really feel right. And at the end of the day, whoever makes that tender or that choice of which company will be awarded this project, that person will reflect on, sure, this company doesn't look that great. They just look like they're a startup. They don't look like they don't really know what they're doing, because the brand work is, there's a lot of noise around the company. They're not clearly communicating their brand positioning, etc. So again, I'm talking about all the intangibles, but without the numbers, it's just intangible arguments, and like it doesn't really have
the thing is, I think maybe, and I'll give it some thought, extra support, and maybe the thing is to say, the number is always is somewhere, in terms of you are saying you are either at zero or at a brand that is recognized, that is earning XXX. So obviously that well-known brand that is earning XXX is obviously the best case scenario if you're doing all your awareness and if you're doing versus you are on zero. So maybe the answer is not, and that's very often how forecasting goes in terms of, it's not very accurate, but that's unfortunately how it goes, to say, where do you see yourself compared to that brand? So you'll get a great brand, you'll get a terrible brand, and at what percentage do you base yourself at? And again, apply sensitivities. If I change something a little bit, maybe I can claw back however much going closer to the well-known brand, or you see what I mean? Everything can be linked to a number in finance. It's just to understand it a bit more clearly. We can talk about it offline again, and I'll understand it a bit better, exactly in terms of, maybe, because data is available. There's a lot of data sources. There's a lot of competitor information. Things are public. There's data everywhere, and you can always link it to some data. And again, it always has to link back to a positive NPV. It just really does,
Thank you so much, Nicole.
Okay, any other question? Cool. And then the last thing, guys,
one question. In the individual application assignment, do we have to show the formula method, or do we just write it out as you did for your the example?
You can choose. You can show the financial calculator method, the formula method, the Excel. You can do however method you want to show how you are, the most comfortable method of calculation. So you can post, because your submission has to be in PDF. You can post a little Excel. You can clip your Excel screens shots, but you can't just give me the answer in Excel. You need to show the inputs. So please, in your calculation, show present value equals this, or et cetera, required rate of return, exactly how I've showed you now in Excel, with every single thing, I've shown you your inputs, and I'll take it even one step further to show present value equals this, future value equals this, N equals that, whatever, because your N is going to change. So it's actually, it depends how you want to show and whatever you are most comfortable with.
Okay, so if we write down the present value method for the formula, basically,
fine.
What's it? 1/1 R minus that, the one. So okay, the one in the textbook, basically, we could follow that and plug in the figures and then give you that breakdown step by step.
The more calculations you give, of course, the more I can work with it, and that's what's important. Okay, guys, and then one last question. I've wrote a couple of comments to those that had some interesting practical responses in the Moodle applications. Please put up your hand or approach me on Saturday just to say you're the one that had the interesting post that I'd just like to open it up for class discussion. Okay, if you are one of those. But well done so far, guys. Please keep on working. I promise you, I know what you mean. Again, I studied 7 years finance thinking that I knew something. And these things are sometimes tedious, but I promise you, again, in my life, it's these nuts and bolts that has differentiated an investment decision. And I know it sounds meaningful, but it's to actually understand these things. Even in that first simple calculation, it had very little in it. But the way that you apply yourself, the way that you think about investment is what's important. But it relies on underlying numbers and calculations. So keep on working hard. There's a lot of scope to just, if you're just doing your work, then you can get through the module. And again, input into these assignments is going to result in a good mark. Okay, and that's just obvious. So keep on working and good luck. And please email me anytime for any additional questions. And then I'll see you on Saturday morning. I'll email out the Zoom now, and I'll also email out the slides for the lecture tomorrow evening. Cool.
And the answer sheet for...
Sorry,
Nicole?
Russell? Yeah.
And tonight's Excel spreadsheet.
Yes, it's coming as soon as I go.
And tonight's? Yes, thanks. Great. Thank you. Thanks, eh?
Okay, thank you. Bye, everyone.
Bye.
Thank you.
Thank you, Nicole.
Bye.